Good morning from Chicago. I'm John Kosar, Chief Market Strategist and Portfolio Manager at Asbury Research. Thanks for viewing our latest Following the Money podcast. Today's date is Sunday, April 20th, 2025. Before we begin, just a little bit of information about us. Asbury Research is a registered investment advisor and has been providing both investment research and asset management to individuals and professional money managers since 2005. We have two levels of research service available. We have Asbury Premium, which is our oldest service, which has been around for the entire 20 years. It includes the latest updates on all of our models and some personal instruction on how to use them. And also a once per month teach-in that we do via Zoom, where we go through all of our models, current market conditions, and we answer questions live from all of our individual investors. We also have a version of the premium service that is for RIAs and money managers that has its own special features. We also have our newest entry into the research realm is our Substack newsletter. There's a free version of that, which you can get at asburyresearch.substack.com, and a paid version for only $25 a month. We put this one out there because there were a lot of people that weren't ready to make the jump with us, either to have us start to manage their money for them or to buy the premium service, and they needed a little bit more time, a little bit more information, or maybe they just don't have the resources to go with the premium service. So we wanted to put something out there for those folks. That's what this is. Again, if you haven't done so already and you're following us via the Follow the Money podcast, sign up for the Substack newsletter. It's free. And again, there's a $25 a month version of that. That includes its own model. It's called Asbury Sort Report. We're going to look at that in just a little bit. And so hopefully there's a service there for everybody. So let's get going. There's a lot to cover today. Very interesting times. In today's podcast, our focus is on the current major downtrend in the U.S. stock market, which has been driven by expectations for upcoming tariffs and, according to most economists, the fear of inflation that tariffs bring. Adding even more uncertainty to this over the past week or so is some pressure from the White House on Fed Chair Jerome Powell to lower interest rates in an attempt to bolster a weakening U.S. economy. And even to fire Powell if he doesn't comply. Unfortunately, it's not quite as easy as just lowering interest rates. Chair Powell can't lower rates in the face of upcoming tariffs, which are inflationary, without running the risk of spurring runaway inflation in a stagnant economic environment. So he's pretty much stuck where he is as long as the tariffs are looming in the background. And most of all, even more than these tariffs, uncertainty in the messaging has been the stock market's biggest enemy. 2 months of inconsistent messaging has really made it difficult for businesses to figure out if they should hire, if they should expand, if they should spend money to try to grow their businesses. This uncertainty makes it kind of makes the economy go into the turtle. To use a boxing expression, and I'm afraid that's what's going on now. We're not interested in the politics. Everyone has their own politics, but they don't have any business being in your investment decisions. All we're doing is trying to understand what the environment is, and then we go to our models, which we're going to do in a second, so we can see them visually, see how the money is moving around the board, so we can have a better understanding of what we're dealing with as investors. So with that out of the way, let's start looking at the good stuff here. Let's start taking a look at some of our models. We're going to begin with the Asbury 6. So we are at our landing page, asburyresearch.com, and we're going to go to the Research Center, which is that's the paywall. All of our models are up top here. You see the correction protection model, which we're going to look at in a minute, the CEF model. We're going to look at the Asbury 6. And there it is. So the Asbury 6 is a daily data-driven gauge of the U.S. stock market's real internal health according to 6 diverse metrics, which we selected and grouped together via quantitative backtesting. the genesis of this was 10 years ago, probably going back around 10 years. It started to get harder and harder to stay on the right side of the market because of all the intraday noise that we saw coming out of the markets, specifically the S&P 500. The S&P would be up 100 points one day and down 50 points the next, down 50 points the next, and then a week later we're making brand new highs. It was really easy to stay with a good idea because of all of the mixed messaging and noise that was coming out of the S&P 500. So we took my favorite tactical tools from my 40 years of doing this, and we started to back test them in groups of 3, groups of 4, to try to find something that we could use as a better indication of what the real daily internal health of the stock market is. And this is what we came up with. The 6 constituents are the rate of change in the S&P 500, relative performance between stocks and bonds, asset flows, volatility, trading volume, and market breadth. They're all looking at the market from different angles, so to speak. Not too differently from when you walk into your doctor's office for your annual visit. Your doctor may make a visual guess on what your health might be as you walk through the door. That's the S&P 500. But once he gets you on the bench and starts testing your reflexes and checking your pulse and your blood pressure and listening to your heart and lungs, he gets a lot better under the hood kind of a understanding of what your health is. That's the Asbury 6. Since 2017, the Asbury 6 has stayed right on top of the S&P 500 in terms of annualized performance, about 12% a year-ish. Annualized, I don't have the exact figure in front of me, but only with a 14% maximum drawdown compared to a 34% drawdown for the S&P 500. What's the bad news? Well, it's very active, and it's meant to be active. It's meant to be kind of an EKG. Again, we're using the medical terms for the market. It moves about 12 times a year, 12 round turns a year. So extremely active, but it really limits the drawdown. The next one we're going to go to is our CPM. So we're going to go back to the Research Center. CPM stands for Correction Protection Model. This is our model. This is traded by our subscribers. We actually use CPM as one of the components in 4 different model portfolios that we offer to our clients for asset management. And this one moves less. CPM is built to stay in the market as much as possible, but moving out of the market when the internal conditions of the market get weak enough where there's extreme danger on the other side. There's danger of being long the market. CPM is a completely data-driven dynamic stocks bonds allocation model. It was really built, there it is, have a look at those signals while I'm talking. It was designed to replace the outdated static and arbitrary stock bond allocation that you might get from your advisor. Your advisor may ask you 10 questions and say, well, according to our questioning, you're a 60-40 stock and bond man or stock and bond person. And it completely disregards whatever the market conditions are. It sets it and forgets it, so to speak. So what we did is we built this model, which when the model tells us that we should be risk on because of what's going on in the market, we are in SPY. When it tells us that we should be risk off because, again, not how this thing was set up for me by my advisor 3 years ago, but what's going on in the market right now, if it shows that there's danger, it goes to risk off, and we switch from SPY over to BIL, which is a short-term ETF that tracks short-term interest rates, treasuries, short-term treasury bills. So we're always back and forth between SPY and BIL. You can see that we are currently on a risk off. As of the signal was on April the 2nd as of the close. So we were out on the open on April the 3rd, and we avoided all of this. This is the purpose for CPM. When the stock market is, again, when it's healthy, we're fully invested in SPY. When it's not, we're fully invested in BIL. Year to date, CPM is down 5.6% versus the S&P 500, which is down 10.2%. And at the extreme, all the way down here, so we went risk off up here. So at the extreme, CPM was down 5.6%, down versus 17.8%, which the S&P 500 was down right here on the lows that we made in early April. So it lets older, wealthier, and more risk-averse investors to play the game with less risk. Next thing we're going to look at is sector rotation. Another one of our models. We're going to go back here to the Research Center. Actually, what we're going to do this time is I have the CEF model on another slide, and it is right here. So this is the CEF model right here, and CEF stands for Sector ETF Asset Flows. It's currently overweight. You could see up at the top XLF and XLU. The CEF model, like CPM, is totally data-driven, but this is a data-driven sector rotation model. This was created to quantitatively identify long and overweight opportunities in U.S. market sectors by following the money as it moves around these 11 sector spiders, which if you add them together, it's the S&P 500. The CEF model is always fully invested in the market. Uptrends or downtrends, whatever it is, it's always invested. It's meant to be the dynamic alternative to the traditional buy and hold portion of a portfolio, just like the CPM is meant to be the alternative to your stock and bond allocation. So we're always invested in CEF. Most investors that I've come across in my 40 years of doing this do not like to be 100% cash. They're not comfortable being in cash. They want to have some core holdings in the market. That's what this is meant to do. But instead of just kind of blindly putting it in the S&P 500 or in the S&P 1500, this is investing in the places in the S&P 500 where the money is going. According to hypothetical backtesting, since its inception in June of 2018 through the end of last year, the CEF model has significantly outperformed the S&P 500 by more than 7% on an annualized basis and a little less risk than the S&P 500. But right now, we're looking at financials and utilities, XLF and XLU, as the top two ranked sectors according to CEF. Again, note that the Asbury 6 and CEF and the rest of our data-driven models are a part of Asbury Research's premium research service, and you could get more information on that by going to asburyresearch.com and using the contact tab up on the upper right portion of your screen so you can ask for information from us. Now let's take a look at some individual charts. These are excerpted from another one of our premium reports called Keys to This Week, which was published on Friday. The first one we're going to look at is the S&P 500. This is daily chart. This goes back to the early to middle part of 2023. You can see the 250-day moving averages are here in orange and in blue. That's the major and the minor trend proxy. And here's where we closed on Friday, right around 5,300, right in this area. So major resistance is 9% up above the market at 57.52 to 57.73. That's essentially the 200-day moving average. It's a major trend proxy that most people use as kind of a back of the envelope way to determine what the major trend is. 9% the other way, down underneath the market, is the January 2022 benchmark high of 48.19 and the 47.70 current location of the uptrend that was drawn off of the COVID low that was made in March of 2020. So we're kind of in no man's land here. We're 9% underneath major resistance and 9% up above, I would call, long-term support. As long as we stay in the middle, the market is in kind of a safe spot right now. The next chart we're going to look at is a lot more tactical, and this is the VIX. You got the S&P 500 since January up here on top. Down in the bottom in blue, we've got the VIX with its 21-day moving average. Why the 21-day moving average? That's Asbury Research's tactical time period that we track. What the chart showing is when the VIX moved up above the 21-day moving average, which is the red, indicating a monthly trend of increasing investor fear. We had a move down from Feb 21 to March 14th, right in here. Then we had a little respite where the VIX started to calm down a little bit from March 19th to April 2nd. That gave us a little bounce that failed. This was the bounce that failed at the resistance level at the 200-day moving average. And now since April 3rd, VIX has been above its 21-day moving average. It's currently at 28.94. Let's call it 29 even so we can remember it. As long as the VIX next week stays above 29, we're likely to see a more apprehensive market and maybe further downside. If the VIX can get back underneath 29 and stay there next week, we may see a little bit of a move higher, a little sigh of relief as the market gets a little less fearful and maybe start moving back towards the major resistance that we showed you in the previous chart. The last chart we're going to look at is longer term in nature. This is a breadth metric that measures the percentage of the percentage of NYSE stocks trading above their 200-day moving average. That's down here at the bottom. What this chart is showing is when market breadth gets washed out, as it is now, where only 10% of these stocks are trading above their 200-day moving average. That's usually a time that we start looking for a more strategic bottom. Not a tactical top or bottom like the VIX shows us, something more strategic. That's where we are right now. This can stay down here for a month or two. This is not a timing tool, but this tells us we're getting in the neighborhood when we should start looking for another bottom. These last few bottoms here, this was June of 22, right before the October 22 bottom, which is right next to it there. This is the COVID low here in March of 20. This is a pretty important bottom in December of 2018. This is January 2016, and this is all the way down at the bottom of the financial crisis here. So a lot of data here. This is a very good indication of telling us when we're getting in the neighborhood of a bottom, but it doesn't tell us if we're there yet. So that's 3 charts that I really wanted to spend some time on. Hopefully it gives you a little bit of a sense of where we are, both from a strategic and a tactical standpoint. The next thing I'm just going to mention quickly as we go back let's move back over here, back to asburyresearch.com just for a moment. I wanted to mention one of our model portfolios. We've used the CEF model, the CPM model, and other inputs to create 4 model portfolios which we use to manage money. Made available to individual investors through Charles Schwab and to RIAs where Asbury Research would act as a third-party asset manager, also through Charles Schwab or through Amplify, which is a TAMP. All 4 of our model portfolios are based, again, on our own models, are all individual components of these portfolios. Year to date, our most conservative one is the Asbury Ultra Conservative Portfolio. Asbury Ultra Conservative Portfolio is down only 3.1% year to date, compared with down 10.2% year to date, as we had mentioned, for the S&P 500. This portfolio is a blend of our CPM and CEF models, plus a short-term bond ETF. To request further information about the model portfolios, again, Asbury Research, go over here to the Contact tab, and in the text box, put model portfolios, and we will send you all information on all 4 of our model portfolios, which have different risk-reward profiles. Finally, let's take a look at our sort report, which is a part of our entry-level Substack online newsletter called Asbury Research Chart Focus. We're going to get over there right now. So here's Asbury Research Chart Focus. This is the one that has a free sign up if you like, but we're going to look at the sort report for right now. This is from the 15th. of the month, which was just a few days ago. Again, the purpose of the Substack newsletter is to provide more investors with an affordable way to learn more about us, and maybe get involved with us on a little bit more significant level as you become more comfortable about what we do. Let's talk about the SOAR report right now. The SOAR report tells us which parts of the global markets have positive trends. Right here are outperforming their benchmark. That's the column right here. And have positive asset flows, which means that new money is pushing the prices of these ETFs higher. This is a very low-cost way to make better investment decisions based on data and not opinion or not somebody else's economic forecast. So we've got gold here is the only one right now, all three across. And we've been overweight gold since the end of January. We've been in and out of gold 3 times. We've made money all 3 times. But right now, we have gold here, crypto, U.S. technology, U.S. interest rates, global equities, U.S. dollar, crude oil, commodities, emerging markets, U.S. small cap. Comprehensive list of assets from all over the globe. The only one right now that is green or positive, and all 3 are gold, is gold market. So if you're looking for somewhere to invest during these tough times when the U.S. economy is sputtering a little bit and there's a lot of uncertainty in the air, this is telling us that the only one right now that's clicking on all cylinders is currently gold. So there you go. We had a lot to cover today. This is a longer one. I hope it was worth your time. That wraps up our Asbury Research is Following the Money podcast. Our next podcast is going to be tentatively scheduled 2 weeks from now, which is going to be the 4th of May. Getting into May already. For questions or more info on any of the research models and model portfolios we talked about today, contact us via the contact tab. And please don't forget to like and subscribe. Enjoy the rest of your Sunday, everyone.